this statement will shock you.
Let's say I have a house. I pay $500 for it, and it costs $400. And that's why I'm underwater in 2008.
As Peter Schiff, an American stockbroker, made an amazing statement, calling the current economic situation a continuation that threatens to surpass the severity of his predecessor. The head of the Great Recession, famous with his views on the press, he draws parallels with the last crisis, but argues that the risks are deeper today. Comparing the two crisis changes indicates that, although the 2008 financial crisis was primarily characterized as a banking crisis, the current situation is downplayed by the media, which is often referred to simply as a banking crisis shift. But the unpleasant truth remains that this continuation will be more serious than the genesis of the 2008 crisis, since the contours of the changes can be traced back to the Federal Reserve's decision to maintain interest rates at 1% from 2002 to about 2004. This artificially low interest rate has led to the emergence of risky financial products such as adjustable rate mortgages and loans without documentation. In the era of cheap money, when the Fed eventually normalized rates, raising them back to about 5%, the housing market schedule collapsed and its consequences in the financial market worsened much worse. Schiff's ominous forecast is based on the belief that the mistakes made by the Federal Reserve after 2008 are much worse, despite the implementation of quantitative easing and lowering interest rates to 0% to mitigate the immediate effects of the 2008 crisis, the subsequent monetary measures of the Fed. Political decisions have inflated a much larger credit bubble, according to Schiff estimates. Banks, especially the two large bankrupt institutions that managed to escape in 2008, were in a much worse position than before their size increased and their insolvency deepened, creating the basis for a financial crisis. This, according to Schiff, has just begun.
It's a little different from what it was in 2008, so today is the most valuable. The asset that a homeowner really has, more than his house, is his mortgage. Many people will want to stay in these houses even if the price of the house drops. Their mortgage is so low that it can still be cheaper. Say I have a house and I paid $500,000 for it and it costs $400, and so I'm underwater again in 2008. The borrower would say, "Well, I'm wasting my money. Why am I going to pay this mortgage? I mean, what do I have negative equity? I'm just giving money to the bank, I'll go rent something, or maybe I'll buy something else at a lower price." But even if you bought something at a lower price, if the mortgage was 8% and not 3%, even if I got a better deal on the house, my monthly payment would be higher. And the same with the rent. Many people can live in a house for which they paid $400,000, which costs $300,000 and maybe even $200,000. But the mortgage is so low that if they just left and rented the property, their rent would be higher. So, it doesn't matter that I give the money to the bank. I need somewhere to live. I'd rather give it to the bank than the landlord. So it's an incentive for people to stay in their homes and keep making payments, even if they have negative equity. So it will keep some of the supply out of the market. Maybe most of the supply I have. I've never heard it explained this way. It's great. What you just said is what's going on. And it also means that people can rent out their house, not just sell it. Because if you sell it, you lose a mortgage, as it should be. The house and these mortgages are not assumed, so the new buyer will not be able to get it. But the tenant can benefit from your mortgage because you continue to pay the mortgage, and he gives you a renting. So we have the right scenario, and so they keep their mortgages such that they can continue to pay even if their home prices go down. They will be less inclined to sell for obvious reasons, even if we had a massive collapse in house prices due to mortgage rates. If they weren't low too, they'd be paying more money for less houses. Yeah, I mean, if the market collapses and then the Fed can cut rates and mortgage rates fall so well again that the same amount, and so people will still leave, there will still be foreclosures.
As Peter Schiff's ominous warnings echo, a more detailed study of the impending crisis shows that attention is focused on the real estate sector. Schiff defines the investment real estate market as a critical pressure point in the current economic situation. The rise in interest rates caused by the actions of the Federal Reserve System. The aggressive campaign has caused considerable tension among most property owners. Across the country, the parallel with the housing bubble of 2008 is striking, but this time, the concentration of risk extends not only to residential real estate, but also to commercial real estate. Office buildings, numerous family housing complexes and apartments are in the spotlight. A significant factor contributing to this turbulent scenario was the law passed by Congress in 2012. Promoting real estate syndication and creating conditions for online marketing of real estate investments after the COVID-19 pandemic, the real estate market boomed, helped by zero interest rates and significant incentive injections. However, prices soared and rents rose sharply in the market. Having entered a state that some call mania, now that the bubble is deflating, real estate syndicators face the challenge of raising funds or selling real estate. To prevent foreclosure, the analysis of changes goes beyond the immediate crisis, highlighting the long-term effects of the Federal Reserve's monetary policy. The prolonged maintenance of artificially low interest rates, according to Schiff, stimulated excessive borrowing and risk-taking in various sectors. Staying consistently low has led to the cyclical use of leverage, creating a time bomb all over the world. The economic shift's warnings about the real estate crisis are not isolated, but part of a broader story that highlights the far-reaching implications of the Federal Reserve's decisions as the fallout from the 2008 crisis unfolds. The politics of augmented reality and its profound impact on the economic landscape.
$200,000 house is 1,000 ounces of gold, right? Now you can raise the value of this house from 200,000 to 300,000, but it can rise from 1,000 gold to 500 gold. So it doesn't matter that the price has gone up in dollars, it has gone down by half in dollars. Real money and all this gives you a better idea of what's going on. Do you think people now, if they are safe or can afford the payment, it is reasonable for them to buy a house? And that in the next few years, we will see prices are going up. Well, I was telling people, before the rates went up. And I said, look, buying a house is a good deal if you get a 30-year mortgage in threes, because it's a great deal to get such cheap money. So even if you overpay for your house, it's okay because the loan was cheap now. When the rates are higher, it's not like, it's clear that you're paying 8% now instead of 3%, yes. But I still think that there will be a lot of inflation that will destroy the mortgage. So it may depend on, the time well, where the house is, how much you pay for it, the area. Well, I like to look at you to know the construction costs or replacement costs. If you can buy a house for less than it would cost to build it, and the land is free, then that's fine. It makes sense, because that I got the land for free and bought the house for less money. How much will it cost me to build this property? It can be an investment if you buy it, and it brings cash flows, and you have 10 inches, and that it works, the math works, and you get a good return on your money, right? Positive cash flow. And you can increase it, and it's an investment. But just by buying the house you live in, it's not an investment, because your property is getting cheaper by more than time.